Hello, everyone. Can you hear me okay, or do I need to turn the sound up? By the way, the stream delay is quite massive, so I will be reading chat a fair bit later than you guys can type. Yeah, I just got your guys' message. Okay, cool. Ugh. Well, welcome everyone to my lecture. It will be From Rags to Riches to Rags, Stocks and Options for the Uninitiated. So I guess we'll start right away and go into the agenda. First on the agenda is what are derivatives? What can options do? How can I use options for my financial goals? And lastly, we're going to make a slight detour into some of the personalities of the options trading community, and we'll delve into Wall Street bets and some of their antics. Okay. Cool. All right, let's go. So first off, let's give an intro to just the stock market in general. So companies can sell parts of themselves, parts of their ownership, in the form of stock, which are called shares. And by owning these shares, you very literally own that company or that portion of that company, which is why you hear someone say, I have a majority stake in this company, or if a majority stake is important in a company, because it ultimately means that you get to make decisions on what happens. One thing that to keep in mind is that stock price is completely arbitrary and is completely based on sentiment. So to explain this a little further, stocks have we all know that you can trade shares of Amazon for I don't know, I think it's around $3,100 right now. And what gives that value? There's basically nothing that gives it value other than what people are willing to pay for it in terms of a share of Amazon. So if everyone decides one day that a certain company is going to be less valuable, then it will be so, just because people started trading that way. And this is really important because sometimes it's less important on what exactly a company is doing, and sometimes more important on what exactly the investors are doing around that specific stock. Another thing is that some stocks do pay dividends. I would say most of them do, but there are many that are hotly traded right now that do not pay dividends on a quarterly or annual basis. I should probably check chat once in a while. Where is the 2x speed button? Okay, George, thank you. Next slide. Stocks mostly hold their value in terms of how investors see them through dividends. The dividend discounted price model is the main way in which we calculate this. It evaluates the cash flow as if you were to receive the same amount in dividends every single year for literally forever. Obviously, you're not going to live forever. You're probably not going to hold the stock forever, and they're probably also not going to pay the same dividend forever. But it is a good base to start understanding the basics of what exactly the stock might be worth and whether it might be over or undervalued. An important thing to keep in mind is that investors look to the future for gains. They do not look in the very short term in terms of how stocks are priced. Very often, you'll see a company with a massive valuation that is really not making that much money. But it is because of the belief of investors that the value of the company will increase, that the company is priced so well. This is happening right now, literally right now with COVID. As we know, there are many, many businesses that are just tanking right now in terms of their revenue, but Wall Street as a whole is doing quite well. And that's kind of weird, and it can be pretty confusing to understand when looking at it from an outsider's perspective. And it can sometimes feel like there's some market manipulation, but this is just how investors, this is just how they act. There is a strong investor sentiment in the US that the Fed will continue to support very low interest rates and keep projects profitable through the massive amount of money that they're just sending into the economy. So investors are hopeful, which is keeping these stock prices up. Remember that these stock prices are based on what investors believe will happen in the future, not what is happening right now. But wait, Amazon doesn't pay any dividends, but it is one of the highest market caps in the market at $1.5 trillion, which is kind of wild. So as I've said, investors look in aggregate for future returns. And Amazon has basically proven itself to its investors that, hey, we won't be paying you your dividends for a while, but we're going to use that money to further expand their growth. So that way later down the line, maybe 10, 15 years down the line, they can have a much bigger return than they would if Amazon had just paid them their dividends right then and there. However, this is one important thing, is that investors can sometimes get pretty angry, and if they're persistent enough, they can sometimes convince the company to give them a dividend. This happened with Apple recently. I don't remember exactly when, but basically investors got they felt that Apple was done with its explosive growth phase and was therefore able to begin its obligations to pay dividends. And so we'll get right into derivatives. So derivatives are not the derivatives that you do in math class. Derivatives are a special type of asset class, and they have their own valuation based on some other assets. For example, these are forwards, futures, options, and exotic derivatives. We're going to go over forwards, futures, and options in this lecture. These are explicitly not just portions of the stock, like if you were to say, I will trade you 0.25 shares of Amazon. That technically that is based on the price of Amazon, but you're pretty much just trading Amazon at that point. And if you're going to invest into the S&P 500 index, SPY, you're pretty much just investing into those specific shares at that whatever portion that is. So that's not really considered a derivative. So what really are derivatives? Derivatives are, for the most part, they're contracts, and these are mostly made to hedge risk, and to mitigate risk, but some are meant to speculate and take more risk. I should probably read chat right now and see if there are any questions. Red tie so smart. Yes, I am. This red tie actually adds 20 IQ points. Not seeing any questions, so we're moving on. Contracts. So, contracts. What does that even mean? So, one interesting thing to consider is that derivatives were actually created before stocks. Back in feudal Japan, farming was really risky because the weather could vary from year to year, and that meant that the farmers could enjoy a serious bumper crop one year and be able to cash in mad growth. And some other years they would really flounder because the rains were not as heavy. So they set up a contract with their dealers in order to secure the price of their rice of their crop to a specific price. This is called the strike, and they agreed to sell at least a certain amount. So if the price of their crop like shot up like wild, while it would be nice for them to cash in on that higher price. If the price of rice goes incredibly low, that means that the farmers can take solace in the fact that their rice is still worth at that exact price that they agreed to pay at whenever they signed the contract. So this minimizes highs, but it also minimizes lows and allowed farming to be much safer on the farmers, and basically made it sustainable. Got my ASI bottle. See chat. Oh my god, he's wearing a suit. Move camera, just bleach your hair. You will look like Wall Street Bets Mango. That's me. But what about today? So companies use derivatives all the time, and some industries are completely dominated by them. Most of these are in agriculture, and some are in like natural resources. Other uses are to exchange foreign currencies, exchange asset classes, and manipulate stocks. And the stocks part is what we care about today. Today, the derivatives market in total is worth around $640 trillion, which is an insane amount when you consider that the US GDP was worth $21.43 trillion in 2019. However, this isn't to say that it's $640 million in actual goods. Rather, these are contracts that are often self-referential. Often they cancel each other out, as I'll explain a little later on. Any questions? Make sure to put your questions in the chat. Charles, there will be graphs. So contracts. Let's go over a specific contract so we can get a better idea of what exactly the math might be behind the valuation. So for example, if I enter to buy a contract for 100 pounds of corn from a farmer at 50 cents per pound, that matures on January 1st, 21st. Oh my gosh. I put January 31st on the next slides. It's whatever. At January 1st, 2021, I will pay $50 to the farmer, regardless of the current price of corn. And this is where contracts derive their value. So let's imagine what would happen if the price of corn is different at the end of maturity. So what if the value of corn at January 31st, we'll just assume it's 31st from now on, is instead 60 cents. So that means you bought, so let's revisit the contract. You said that you would buy 100 pounds of corn at 50 cents a pound. And now you have 100 pounds of corn, but now it's worth 60 cents a pound. That means you have $60 worth of corn for only $50. And you can resell that to the market for a tidy $10 profit. The value of the contract itself would then be $10, because let's imagine if you were to sell this contract to someone, you would only be able to get $10, because that's how much extra value that the contract provides, as opposed to just buying the corn yourself. What if instead the value of corn at January 31st was 40 cents? That means you bought $40 worth of corn for $50, and you can only really resell for $40. So then the value of the contract would instead be negative $10. So let's go to the next slide. I've graphed it out here. We can see as the corn price increases, the contract value also increases, and as the corn price decreases, the contract value also decreases. And it's important to note that the point when the contract value is 0 is not at when the corn price is 0, but when the corn price is at the strike, when the corn price is at the 50 cents that you agreed to pay. This is important. Let's imagine you have that contract and the price stayed at 50 cents. That means that no matter what, you couldn't sell the contract to anyone for anything because someone could essentially just buy the corn themselves from the market for the exact same price. There would be no need to go to you, and there would be no need to do any of that. Any questions? No. Paul, you look so scuffed in your photo. Now for options. So options are the same kinds of contracts. So they're also considered contracts, but they are optional to exercise for the buying party. That means if you buy it and you don't want to go through with the trade in the end, you don't have to. They also have an expiration date. They also have a strike, the same as with forwards and futures. And all options for stocks are traded in hundreds, so you must at minimum buy 100 contracts. We call it 100 contracts. It's technically 100 contracts, but in the options world, we just consider that 100 packaged together to be one contract. So let's imagine the same scenario as before, a 50 cent strike, 100 pounds. This is called a call option. If the price jumps to 60 cents, you can this in the exact same way, you can earn a $10 profit in the end. But if the price drops to 40 cents, you don't have to actually honor the contract, and you can just buy corn for 40 cents from the market if you still want it. So that means that the contract expires worthless, but it never expires with negative value, as you can see on this graph right here. You can see that it's a piecewise function where until 0.5, the value of the contract is not negative, it is instead 0. And as the corn value goes up from 0.5, the contract value increases in the same way. Now for options. Oh, well, I didn't change the label. Oops. So it's very simple to determine the value of the call at expiration. Just check whether the underlying asset is above or below the strike price. The underlying asset is what we call the asset in which the contract is dependent upon. If it's over the strike price, that means that the contract has real cash value and is considered ITM or in the money. You want your call options to be ITM. If it is lower, that means that the contract has no cash value and is considered OTM or out of the money. You don't want your options to be OTM because they have no intrinsic value. However, it's much more complicated to calculate the value of a contract when you're not right at the expiration. And we care because we can sell these contracts, so we want to know whether we're getting our money's worth for our contracts. So calls. Calls always have a non-zero value before their contract, before their expiry. So that means no matter what, your call is always worth something. Might not be worth a lot, but it is always worth something. And that is because there is always a possibility that the underlying asset could surpass the strike price. So if you have a call on Amazon for like something ridiculous like 5,000, even a call option like that has value, even if Amazon is currently at 3,000. That's because there is a world that exists in which Amazon somehow shoots up to 5,000, and therefore that contract will have value. So that means that it will have value. And the more time until the contract expires, so the further out the expiration date is, the more value that the contract has. This is because you have more time to reach that certain strike price, and more time to surpass it, which increases the price because you have a higher chance of making money. The lower the strike price, the lower the strike price, the more value it has, because that means that the stock doesn't have to go up as much to generate value. So if you have a call option on Amazon, which is 3.1 thousand right now, for 3,000, that means you would be your option is automatically worth much more than someone who has a call option at 5,000, because the chances that Amazon goes to 5,000 at expiry is pretty low, given a pretty short expiry, and the chances that Amazon stays above 3,000 is pretty high, and it already has intrinsic value. Any questions so far? Black hair on gray background is fantastic. Swoons. Thank you, guys. Make sure to ask me questions, by the way. I'm going by pretty quickly, so I don't want to leave anyone behind, because this is the good stuff. This is my major. So this is the industry standard way of calculating the value of a call option. It's the Black-Scholes model, and it has these assumptions that I've written down. It is very hard to use. In actual options trading, in my trades, I've never used this other than to determine IV, and we'll go into that in just a second. But this is really only for institutional investors. Generally, you would assume that pretty much any call option on any major traded stock is pretty okay, fairly valued. So this doesn't come into play too much unless you're trading some underground stuff. So as I just said, IV? What is IV? IV is implied volatility, and it is not actually directly measured. It's instead calculated by plugging in all the other variables in the Black-Scholes model. It is a function of pure investor sentiment. It basically tells you how confident investors are that an asset will reach a certain price. So if IV is high, that means that investors are really think that the price could go wild with this one. And if IV is low, then that means that investors are mostly resident sleepering on that current asset. So you can buy calls, but who from? So as we know, options have value before maturity, and that means if you want to get them, you have to pay some money. You must buy the right, and you have to always pay money to have these call options, but you may or may not have any money at expiry, because these contracts could expire and become completely useless. And so therefore, how much you're willing to pay for an option is a combination of how much you believe a stock will hit a certain price, as well as how much time left there is, as stated previously. So this graph is the same contract as before, but notice how the price is now, the point at which you earn money is now higher than the price at which the contract starts to have value. This is because if you're paying a commission to someone to buy that contract, that means you're losing that money. And if the contract expires worthless, that means you just lost that money, which means your contract is not just worthless, it lost you money in the end. And the price at which your contract is at zero value is when your value of your contract is equal to the value of the commission that you paid. And it only starts making money after then. Are there any questions on that? For calls, if the call is 100 on either side, does it have the same value? If I have a call at 3,000 on Amazon or at 3,200, is that the same? I I'm trying to understand your question. If your call is at 3,000, that means that, and the current price is 3,100. That means that your option is ITM. That means that your option is in the money and your contract has intrinsic value because, let's imagine, you now own the right to buy 100 shares of Amazon at $3,000 instead of 3,100. That means you're saving $100 on all of those 100 shares. So that means that your contract is at least worth 100 times 100, which is 10,000. Wow, that took me a while. However, if your call option is your strike is at 3,200, that means that, and the call option and the current strike price is 3,001. The current, if your strike is at 3,200 and the current price is at 3,100, that means you have the right to buy Amazon at 3,200. And why would you ever exercise that option? There would be no reason, because why would you want to buy for 3,200 when you could just buy from the market at 3,100? That means your option has no intrinsic value, but it still has value to other investors because there is a chance that your option is that the price of Amazon goes to 3,200 and above. Hope that answered your question. So now we've established calls. Calls are a way for you to bet on a certain stock that it is going to go up, and if it goes above the value that you set your strike at, you gain money. If you're below the value, you get nothing and you lose all your money. Another way to say this is that you are long the underlying asset. So if I have a call on Amazon, that means I am long Amazon. Longing is a little different. The usage of long and short is kind of confusing, but just understand that you're long if you're expecting the value, if you're in a situation in which you would want the value of the underlying asset to increase. But what if you want to bet against the asset rather than for? That's when you buy a put. A put gives you the right to sell an asset at a certain price by a certain date. And the price being the strike and the date being the expiry. This means you must either own the shares outright to sell or buy them right as you sell. So you're kind of borrowing for the time that you own the put. So let's go over an example because I think these help. What if you had a put option that allowed you to sell 100 grams of gold for $600 a gram by January 31st? What would it be worth if the cost was $700 or $500 at the end? Thank you. I had an entirely scuffed view of value before expiry. You're welcome, George. So if the price of gold sinks to 500, you have the right to sell. You have the right to sell for 600, not 700. Sorry. So you will have the right to sell you have the right to sell gold at 600 as the contract states, meaning you'll earn $100 profit immediately after exercising. This is because you're essentially you're losing value on your gold. So the gold that you own, it's technically worth right now $500, but you're selling it for $600, which means you're essentially earning a $600 profit or a $100 profit. However, if the price of gold goes to $700, you will not want to exercise because that means you're going to be selling your gold, which you established was at 600, which you won't want to sell your gold because your strike is 600, but the current price is 700. So you might as well sell at 700 if you're going to sell at all, because you're not obligated to sell at 600. You would never want to do that because you're literally just losing $100. Puts, so this means that puts are the opposite of calls. You want downward motion in the stock, so that means you are short the stock. So this is the other side of longing, this is shorting. So this is, since you were expecting or you're hoping for a downward motion in the stock. This I've graphed it out, and so we'll look at the price of gold and the value of the contract, and we can see that as the value of gold decreases all the way to 0, the value of the contract increases by a proportional amount. However, if the contract, so let's say, so this is only if you currently own, so if you are mandated to sell, so if you had a forward on this, or if you had a short forward on this, which means you are required to sell the gold at that specific strike, that means that the line is no longer a piecewise function and continues to go down from 600 because you are mandated to sell, which means you are losing value on the contract because you're mandated to sell. With an option, it's not like this. The value of your contract will never dip below 0. Any questions? Not that I can see. Stream delay is so long that I don't know whether you guys actually have any questions when I ask when there's questions, but hopefully I check often enough. So let's talk about, so far we've talked about when you buy a put and when you buy a call. So what about the people who sell? Remember that options cost money to buy. So that means if you're selling these options, you're receiving a commission that you get to keep regardless of the outcome of the option. The commission you keep no matter what the contract says. It is no way related to the actual contract itself. It is just something that you have to pay in order to become the owner of said contract. Getting assigned. So if you sell a call, so let's remember what a call is. A call means that you are buying a right to buy 100 shares of a stock at a certain price by a certain date. So if you sell a call, that means you're giving someone the right to buy your stock at that price by that certain date. So let's imagine what would happen at expiry when the call expires out of the money. That means the contract has no value. In this situation, this means that let's say Amazon is at 3,100 and you've sold a call for Amazon at 3,200 by November or September 18th. If on September 18th it stays at 3,100, that means that the call is OTM. This means that, so why would the person ever want to exercise that contract and buy shares from you at 3,200 when they could just buy shares on the market for 3,100? The contract has no value. This means that the contract expires and you are no longer beholden to that person, and you get to keep the commission. So you get to keep the shares and the commission. So great for you. However, if the call is ITM at expiry, so say it's instead the person who has a $3,000 call and you sold it to them, that means that you will almost surely get assigned, because that means they get to buy 100 shares of Amazon at $3,000 rather than 3,100, which is great. That means they get to buy at a very discounted price, and that means you will likely get your option exercised. You will get assigned, which are essentially the same thing. The same term, I mean. So that means you will sell your 100 shares of Amazon to that person at the assigned strike of 3,000. However, you still get to keep your commission, and it's not like you're losing all the value of Amazon. It's not like you're still selling it to that person. You're not just giving it for free. Any questions? what is your stream delay at? I don't know, but I remember from testing the other day, like it was like 10 to 15 seconds, something ridiculous like that. I don't know how to turn it down, but we're cool. So let's go over what would happen if you're selling puts. So if you sell a put, let's go over what exactly that means. If you're selling a put, that means you're giving someone a right to make you buy 100 shares of a certain stock at a certain price, the strike. And that means that if their put is ITM, which means let's say Amazon is at 3,100 and your put option was at 3,200. That means you now have to buy. That means that you will most likely get assigned, and that you will buy 100 shares of Amazon for $3,200 when the current price is 3,100. And if the current value is if the option is OTM, that means you get to keep the commission and not have to do anything with your cash. So good for you. This is a little chart I made to simplify the relationship between calls and puts and the buyer and seller side of things. As we can see, calls gain value when the underlying goes up, they lose value, and they are riskier the higher the strike. And puts gain value when the underlying goes down, but you lose value on shares owned, and they lose value as time goes on. One important factor that I want you all to know is we've established that the amount of time left until expiry in an option is an important factor in its value. And that means that a call with a date further out has higher value than a call with a date that is sooner out. That means that as time goes on and as the expiry date comes closer, the value of the call decreases. That means for the seller, you gain value as time goes on, right? Because you're gaining value in that your money is now much more secure, or your commission or your stocks are that much more secure, and you will have to not buy as expensive of a call to cancel out the calls, which we can go over once the lecture ends. What am I at? 28 out of 46. I'm doing good, I guess. Any questions so far? Paul says what? Thank you. So getting out early. So assume you have a Amazon call for September 18th that at $3,000. That means you have a call for Amazon at $3,000 expiring at 9/18. So Amazon, as of September 10th is close to $3,175.11. That means at the very least, your contract is worth $175.11 because the price, because you're essentially, if you exercise right at that moment, you essentially get a $175.11 discount. And the closing price of that call option, wow, I am also blind. It's instead $203.48, not $207.50. The $207.50 option is the 2,995 call option. So yeah, your option is worth a lot of money. This is because options are displayed with contracts. So it says $203, but multiply that by 100, and you'll get the true cost of the actual option itself, which will be, if I didn't choose the wrong option, it would be $20,750. So if you own that call, you essentially own $20,750. Because you can sell that call at that price and cash in a very good chunk of money. That would be the dream. However, we've established that the longer time goes on, the lower the option's value, as the time left for an upswing grows lower. This means that if Amazon doesn't increase any further and stays exactly at 3,175 and 11 cents until November 18th, September 18th, that means the price of the option will drop to $175.11 because there's no more time for it to appreciate in value, and it is now just a simple discount, and there's no chance to make any more money. So if you don't expect any more movement in the underlying asset, it's better to sell earlier rather than later, because later your option will always decrease in value if there's no movement. Obviously, if there is movement, sharp movement, then the call option will increase, and that's the internal debate that you have to have with yourself on whether you want to cash out early and secure your gains, or wait a little longer and maybe sacrifice a few dollars, but also have the chance to cash in significant gains if the underlying stock price goes up. So we've gone over the puts and the calls for both the buyer and the seller, but I haven't really talked about the risk of options. So if you're buying a call option, it is incredibly risky. Options are very risky. This is because let's think about stocks. So if you bought a share of Apple and Apple's valuation crashes by 10%, that would be disastrous. However, if you bought Apple at $100, you would go down to 90. Not all that bad. It is terrible in terms of an investor standpoint, but 10% means 10% only means 10%, and it doesn't mean anything more. However, for options, your calls can be worth everything or nothing. Your calls can decrease in value sharply. Let's say you bought an Apple call at $100 with a strike at $100 for the current market price of $14.38. Apple is currently $114.10. So that means that if the price of Apple drops by a single dollar to $113.10, this is less than a % drop. And assuming the exact same gap between the amount in the money and the call price, the price of the call will drop to $13.38, which is a 7% drop. So already with a very in the money contract, in the money contracts often have lower price fluctuations than out of the money contracts. You're already seeing a factor of 7 increase. So if Apple were to drop 10%, you would see like a 70% decrease. Assuming the same kind of drop, you would see a 70% decrease in the value of your call, which is kind of big. Movement and one thing to keep in mind is that movement of options in the days before expiry can be 10 to hundreds of times the movement of the underlying, because the options are often very cheap, which means they have a lot of room to grow, but it also means that if you buy a lot of them, they also have a very high chance of just not working out at all, and so you can make thousands of dollars off of hundreds, or you could just lose it all. So this makes options incredibly risky. Only play with these if you're willing to shoulder the risk. Any questions? Oh no, Chris, your warnings are deterring anybody. What does that even mean? That's some great English from graduated math major. Oh my god. So let's go over some common strategies, some common trading strategies that are used. I personally use this one. This is called the wheel. So the wheel is this. First, you start off by selling covered calls. What this means is you will buy 100 shares of a stock, and then you sell decently out of the money calls with a strike 10 to 20% higher than the current price. So if you're invested in Amazon and you buy 100 shares of Amazon, which is a lot, that'd be $300,000. But if you're able to, well, $310,000 if you're able to do so, then good for you. So you sell those calls. You buy 100 shares first, and then you start selling calls because now you have 100 shares, which means you can start selling contracts for 100 shares. You can make 1 to 3% a week purely on commissions on these calls, because the calls are often pretty expensive for Amazon. It all depends on the IV of the options, but generally 1 to 3% is what you'll be making. 1 to 3% a week is insane. I want you to understand that over a year, investors often look for 10% returns, 10 to 15% returns. And if you're lucky, you'll get 20. If you consistently make 1% a week on your investment, you will be making 52% returns a year. That is better than almost anyone could ever say they have personally done. That is trading normally with stocks and bonds. That's what you can do. However, obviously, if you're selling these calls, you can get assigned, which means that you will have to sell your 100 shares of Amazon at whatever price you set. If the current price is 3,100, you're probably going to want to set a price of probably around maybe 32 to 3,300. And that means if you bought it at 3,100 and you're selling it at the strike, which is 3,200, you still get a profit from the overall deal, which is buying at 3,100 and selling at 3,200, and you also get to keep the commission that was paid to you for that contract. However, this is one downside to this is that you are stuck bag holding the stock, which means that if the stock really tanks in value, let's say Amazon goes to let's say 31. So if you bought at 3,100 and the stock price suddenly drops for some reason to 2,000, that means your call is most likely safe. However, now your 100 shares of Amazon are worth 33% less than they were the day before, which is very bad. And no 1% return will make that up for you. And you have to still hold the stock because you gave someone the right to buy from you. So you have to buy that contract back in the case that you want to sell your stock. So that means that you have to hold the stock until the contract either expires or you get assigned, which is one downside. So now after you get assigned, you now have a bunch of cash. Now you can start selling cash covered puts. Now you can start selling decently out of the money puts, which means that you give someone the option to sell you 100 shares of Amazon at a certain price that is 10. You should probably do 10 to 20% on this one as well. You get roughly the same margins, but you don't earn anything from the price, because if the price goes up, you're not holding any Amazon stock, so you're not making any money from Amazon. You get roughly the same margins. And you don't earn anything if the underlying goes up, and you only really earn something if the stock price goes. You don't even earn anything. You actually lose money, kind of, because you're losing value on your contract if the stock price goes lower. So this is the riskier side of the wheel. But once you get assigned again, let's say you have a strike at 3,100 and the stock price drops to 3,000. that means someone will sell you 100 shares of Amazon for 3,100. So now you pay $310,000 and you're back with 100 shares. Now you're back with 100 shares, which means you can start selling out of the money calls again. So that's why it's called the wheel, because you go from selling calls, selling puts, selling calls, selling puts. And after a couple of revolutions, you should be making some pretty decent money. Obviously, this is a little risky because these are cash-covered puts, and those have no downside protection. But you get pretty decent returns. Any questions? Well, no. So compound percent. So it's not actually, you're not compounding your money in this case, Jacob, because you only own 100 shares. The money that you're receiving commissions, right? But you're not selling calls on those commissions. I'm assuming that you're doing nothing with the cash that you're receiving in commissions. So it is indeed 52% over the year. You're earning, so yes, you're technically not earning 1% each week. You're earning 1% each week on the original amount you invested, rather than 1% each week on the amount that you have starting each week. My Robinhood referral code, I'll actually make money from this stream. Maybe I will, maybe I won't. The ethics of that are kind of iffy. Another common strategy, the YOLO. This is where you buy a copious amount of a very OTM call close to expiry. So let's say you can on Thursday, you'll buy an option expiring Friday for a ridiculous amount higher. The calls will be very cheap because you're one, buying very close to expiry, and two, you're also buying them very high with a very high strike, which means that the chance of it reaching that price and actually making money for you is kind of low, very, very low. And at this point, you cross your fingers and your toes and hope for an extreme movement upward. If your strategy succeeds, you'll likely earn at least 4 times the amount that you put in, and sometimes more. Some success stories have reported like 1,000 to 2,000 baggers, which is essentially doubling your increasing your money by that much, by that factor. These kinds of returns are seriously once in a lifetime. If you win this, hats off to you. But this is incredibly stupid, because most of the time you will lose all your money, and the people who sold you the calls will be laughing all the way to the bank, and you'll be left very poor and very sad with no stock to your name. Would highly recommend YOLOs. No. So Jacob, if you were to keep buying more stock, you wouldn't be able to sell options on them until you reach 100. You always trade contracts in terms of 100. So I guess if you earn 100% of your money back, then at that point you could buy another 100 shares of Amazon and then start selling calls on those. But until you can buy another set of 100, it doesn't matter what you do with the money. I guess considering you could put it in like a T-bill and just use the risk-free rate, but I'm assuming that you're going to just sit on your hands with the cash and not invest anymore. The next strategy is the FOMO, or the fear of missing out. This is kind of a joke, but after a big rise, buy calls on a really overhyped stock, such as Tesla. Maybe you buy them with a far expiry to feign safe investing, because maybe this will increase by like 50,000% in the future, and I'm just riding the wave for now, but maybe in the future there'll be another big wave, and then enjoy a 15% rise in your value for that trading day. And then you wait for the next trading day because you don't want to be flagged as a pattern day trader. and then you to immediately dump on the next day, and then start crying once the next day everyone starts dumping before you, and the price crashes about 5% in the pre-market, and then your option is worth nothing. This is very bad. If you're going to buy calls, buy them with conviction. Make sure that you're not just jumping on a bandwagon that is set to explode a second after you jump on. At least the YOLOer has a chance to make money with strong financial conviction. If you're FOMOing is the number one way to just lose your money, and lose it slowly and in a very sad, depressing way. So don't FOMO. Always buy calls with conviction. Be smart and don't FOMO. It's bad. Very bad. Very, very easy to just lose all your money this way. Oh, wow. I didn't delete the slide. You'll see this slide later. So now I've gone over most of the educational material, the real educational material. So now I'm going to start going over some of the community of options traders that you can find online. So these are some of my personal largest losses. I lost around about 960. I guess the total amount is like $968. Like completely lost $968 on AMD calls. I was very sad. I FOMO'd into them, and I lost all my money. I also bought those three contracts of gold for about $300, and I lost that all too. I have many more losses that I didn't have space to fit, didn't really want to fit. I have had some big gains as well, but these are some of my losses that you can laugh at and have fun with. Feel free to have a good laugh at these. So Wall Street Bets. Let's go over what Wall Street Bets is. So Wall Street Bets is a subreddit on Reddit where users post very, very, very financially irresponsible decisions and the results for some juicy Reddit karma. And whether you are into the stupid decisions made around money or not, they have some of the best, and I mean the best memes I've ever seen anywhere on the internet. They are the truly masters of their craft. One common term you'll see thrown around is tendies. Tendies in Wall Street Bets lingo stands for cash. The term originates from legal tenders, so someone decided to make a play on it and just call them chicken tendies. And now tendies are synonymous with cash, which is why sometimes I say tendies, because I love me tendies. And pictured here is the savior, the Lord and Savior of Wall Street Bets, Mr. Musk, handing out tendies, passing out the tendies to feed the 5,000. This is some scientific stuff. Oh, his face makes me laugh every single time. Here I'm gonna go over two cases from Wall Street Bets, one dramatic failure and one dramatic success. First, we will begin with the tale of Irony Man. He is truly a legend among the Wall Street Bets community. So what he did was he exploited a glitch in Robinhood that was there for a couple of months, I believe, or a couple of weeks, where you could essentially borrow infinite money from Robinhood with a very convoluted method of selling covered calls and buying them back, and then selling covered calls again, and somehow that would mean that Robinhood gives you a lot more money. His trades involved box spreads, which are an arbitrage position. These are essentially combinations of calls and puts and selling those same calls and puts, and they perfectly cancel each other out, but they leave some commission behind. So technically, and he was correct that it was almost, very almost risk-free. However, some of his options got assigned, but because and so he was forced to buy. He was forced to buy a lot of shares of Apple, I believe, but because he had to buy so many options, but since he was leveraged basically on no cash, he had no cash at all. His account went really, really in the negative, and his options were canceled. Were left without pairs, and that left him with $50,000 in debt. About. So there is a screenshot that he took of him losing a lot of money in a very, very silly way. He made a funny noise while doing it, though. Check that video if you'd like for yourself. Just look up "gah." And lastly, we will go over Wall Street Bets God, the YOLO and the YOLO of legends. So we've established earlier that YOLOs are stupid, very, very stupid, and you should only do it if you're really ready to completely part with the money and essentially just toss it away into a burning volcano. But what if you win a YOLO again, and then you win another, and then you win another? That's when you become Wall Street Bets God. This is one of his trades where he turned $46,000 into $1.4 million. This is like a 50 times increase, or like some ridiculous amount. I think actually like 70,000 increase, 70 times increase. To get a 70 times increase on anything means you've basically made the deal of your lifetime. He turned very little into a lot, and then he did it again, where he turned another $125,000, taking money from his previous trade, and turned it into $4.3 million. And then he did it again, where he turned 70K into $1.5 million. So this just is every day for Wall Street Bets God. Currently posted on his Twitter, his latest video shows him holding around $23 million in assets. And that all began from that 43K. So if you're going to be financially irresponsible, don't be like Irony Man. Be like Wall Street Bets God. And Godspeed, you tendy mongerers. Any questions? The reports of my demise were grossly misrepresented. Yes. Yeah. I'm reading these much later than you guys are sending them. So any questions? Any at all? If not, thank you everyone. I seriously appreciate you coming. This was a lot of fun to make. It was kind of rushed on my part. I may have procrastinated a bit, but I did put a lot of effort into it, like a good amount of hours. It was a lot of fun. I would love to give any more. I would love to talk more, but it looks like my time is over. So yeah, if no one has any more questions, yeah, I will be, I have the, I can send you the, did I save it? Oh, Pog, that's the link. to the Google Drive. I put it on Google Drive. So yeah, thank you everyone for coming. Peace. Goodbye, OBS.